Is the stock market patterned? That's a high-stakes question. The way you think as an investor and virtually all of your investment decisions depend on whether you say yes or on whether you say no. If yes, that means the market's price trends and turns are, I'm going to say it, predictable. If no, that means the search for price patterns amounts to Captain Ahab's hunt for the white whale. If you want to anticipate trends, you're stuck with the same news headlines as everyone else. So yeah, the stakes are high. But we are talking about the stock market, in fact about all major financial markets, which is a good thing because that means we have data, continuous data, copious, reliable data going back more than a century. And when you have data, you can do what educated people are supposed to do to answer a high-stakes question. You make observations, you form a hypothesis, you test it against the data. Our observations tell us that yes, markets are patterned. And it's no exaggeration to say that we've tested that premise against every trading session since 1979. Yes, we continue to make adjustments, but so far the hypothesis stands up. Markets are patterned. Now, just to be clear, we're describing a collective pattern of behavior. At any given moment, the price of the Dow Industrials or S&P 500 reflects millions of real-time decisions. Stock indexes are the broadest, most accurate measure of social mood that we have. The most basic pattern looks like this. The trend unfolds in 5 up, 3 down. That was R.N. Elliott's observation and hypothesis 80 years ago, and it's the one we test to this day. Yet you've stayed with me so far in this episode, so I assume you're at least open to our hypothesis. In turn, I'd like to show you, and I do mean show, the main alternative to our hypothesis. I think of it as the rest of the world's default hypothesis. Put simply, economists and policymakers describe what has already happened and make that the forecast, which isn't a forecast at all. Yet it's still what you usually get from talking heads and media stories. It's the linear model behind phrases like this.
Consensus estimate. Consensus estimate.
Consensus estimate.
Consensus estimate.
And because the so-called consensus fails to anticipate change, it's also why you often hear phrases like these.
Lower than expected. Below what was expected. And the lower than expected.
The fancy word for this is extrapolate. You take the current or recent trend and project it into tomorrow. As I said, the consensus model is the default hypothesis, and it dooms you to playing catch up with the trend, especially with major changes in the trend. What am I talking about? This is where I show you, not dusty relics, but real history at its most amazing. History which takes the facts and evidence from sort of clear to a stunningly crisp, high-resolution insight. So, let's look at 3 sudden, huge turns in the stock market. Each one of these turns actually defined 3 major periods. I'll include a prominent quote from each period which captured the sentiment of that time. Each amounts to someone describing what already happened and making that the forecast. Example 1 is the 1920s versus the 1930s. Our first example came after the multi-year bull market of the Roaring '20s, a phrase which of course refers to the raucous mood of the time. Irving Fisher was a Yale professor and the country's most respected economist. He said this on October 16, 1929.
Stock prices have reached what looks like a permanently high plateau. I expect to see the stock market a good deal higher than it is today within a few months.
But Irving Fisher's forecast had less than 2 weeks to live. The epic Black Tuesday came on October 29, 1929. Note the 5-wave pattern into the peak. The Roaring '20s became the Depression '30s. The money and sound and color of the Great Gatsby gave way to the hardscrabble poverty of the Grapes of Wrath. Example 2, the decade before 1966 versus the decade after. I'm talking to you, baby boomers, because you were there. Most people know that mood shifted somehow in the 1960s, but for us the timing is all important. You can pinpoint it right there in January 1966. Here's our second quote from President Lyndon Johnson in December 1964.
These are the most hopeful times in all the years since Christ was born in Bethlehem.
That is an optimistic forecast. LBJ had just won a massive landslide in the 1964 presidential race. He had huge majorities in the Congress, the economy was booming, his Great Society legislation promised to eliminate poverty and racial injustice, but 1 year later, everything changed because the mood had turned. Here's the chart, and again, note the same five-wave pattern into the turn. Lyndon Johnson and the Congress escalated the Vietnam War. 58,000 U.S. troops died in that conflict. Most of the combat deaths were in 1966, 1967, and 1968. Violent student protests broke out, so did urban riots in the long hot summers in Los Angeles, Newark, and Detroit. Less deadly but equally visible cultural turns also arrived in TV, music, and movies, such as going from The Sound of Music in 1965 to Easy Rider in 1969. Then there was this on August 9th, 1974.
Therefore, I shall resign the presidency effective at noon tomorrow. Vice President Ford will be sworn in as president at that hour in this office.
That event is unique in U.S. history, and it just happened to transpire within a few weeks of the lowest price low of the 1970s. Example 3 is the 1990s versus the early 2000s. Last, not least, and most recent is a quote that captures the mood at the end of the bull market that took off in the early 1980s. In July 1998, the Wall Street Journal published an essay from an economics professor at MIT. Gentleman said, "This expansion will run forever." And he single-handedly outlawed a recession and bear market. We don't need one, we don't want one, we won't have one. Our policy team will keep it from happening. The market won't melt down. Once again, it was a relative few months later that the market defied this overconfidence. The trend turned in early 2000 at the end of a five-wave pattern. The decade that followed included the dot-com bust, 2 large bear markets, and the worst financial crisis since the 1930s. The pattern of overconfidence after long bull markets is as predictable as the bull market pattern itself. Let's end where we began. If the market is patterned, you should be able to anticipate or attach a probability to those turns. For more on that, see the episode titled Financial Markets Are Fractal. You're welcome to listen to our entire Pillar series, all in one sitting or one episode at a time at your convenience. Thank you for your time. The link below will take you to the next episode.